Hey y'all, hey, Keisha West here. Today, you all, we are going to be talking about retirement withdrawals and taxes. A lot of people have to take money from their retirement account, but many people are not educated on how this actually affects them when they file their taxes. If you are new to me, I'm Keisha West. I am an enrolled agent licensed by the Internal Revenue Services to assist taxpayers and business owners with individual tax preparation and business taxes. My industry that I specialize in is the trucking industry. So if you all know any truckers looking for a professional tax person, make sure you share my page with them. Happy Friday, Natasha. Thank you for tapping in. Today we're going to be talking about retirement withdrawals and how they affect you at tax time. So if you all see me looking over to the right, it is because I have my notes. I want to make sure that I am giving you all accurate information. And we all know these IRAs and 401ks, all of it continue to run together. So if you all have any questions, any tax questions, make sure you send them to Keisha, Kisha, what if at gmail.com. I get a lot of what if questions. So what I've decided to do on Wednesdays, I'm going to come on, go live, and go over my what if questions from people that I have received questions from throughout the week. So just tap in with me, y'all. Again, we're going to talk about retirement withdrawals and how it affects you at tax time. Okay, let's start with the traditional IRA, the traditional individual retirement account. So the traditional IRA, this is purely an individual's retirement savings. It's not attached to an employer. This is just a simple retirement account that you are saving on your own. Now, if you all withdraw money from out of this account before the age 59 and a half, then you will have to face a 10% withdrawal penalty. Unless you have, also, if you have like some exceptions, there are some exceptions like a first-time home buyer, certain medical expenses, also any higher education expenses. So there are exceptions, but keep in mind, if you do not qualify for any of these exceptions, then that money that you withdraw from your traditional IRA is going to be considered income. And when it's time for you to file your taxes, that could possibly have you owing in taxes. There is an option to get money taken out when you withdraw your funds. They do ask you, do you want to pay taxes on this? Yes, you can opt to do that, or you can opt not to do it. It'll help a little bit, you all, but you still may have a penalty if you don't qualify for any of those exceptions. Okay, let's talk about the 401k. Now, the 401k, that is an employer-sponsored retirement plan. So the 401k is attached to an employer, which they often have additional benefits. They may give you like a matching contribution. If you put in 5%, they may match it. So there is a benefit to having an employer 401k plan. But also, just like the traditional IRA, the withdrawals from a 401k are typically taxed at your ordinary income tax rate. So if you withdraw money from your 401k, again, you will have to pay taxes on that money the same way you would do a traditional IRA. So keep in mind, if you are taking money out of your retirement accounts throughout the year, you will have to pay additional taxes on that if you don't qualify for those exceptions that we talked about earlier. Okay, it says in regards to the 401k, if you withdraw money before 59 and a half, that's when that penalty will apply. And the exceptions to the 401k could be things like separation from your service after the age of 55, the certain medical expenses, a qualified domestic relations order. So there are different exceptions to these retirement accounts. You just need to determine which one applied to you. Okay, so that was the traditional IRA and the Roth IRA. Now let's talk about the Roth IRA and the Roth 401k. Okay, the Roth IRA, this is a retirement account that if you withdraw money from the Roth IRA and it's been open for 5 years and you are 59 and a half or older, then your withdrawals are tax-free. So there is a benefit to having a Roth IRA. However, if it's not a qualified withdrawal, which meaning that the account has not been open for 5 years, then it could be subject to a 10% penalty on your earnings. But we all know that with those Roth contributions, that is after tax dollars. So the contributions that you put in, you can withdraw them tax-free at any time. However, what you would be paying taxes on is that interest that you may have acquired, you know, the earnings that you acquired while they was in there. That's the part that you're going to be paying taxes on when it comes to a Roth IRA. Okay, now let's talk about the Roth 401k. So the Roth 401k, this is also an employer-sponsored retirement saving plan. It combines both features of the traditional 401k and the Roth IRA. An example that I want to give you all, think about it like this. So you all know with the traditional 401k, these are made with the pre-tax dollars. That means that they go ahead and contribute the money, but they have not taken any taxes out. That's why when you take that money out throughout the year, you're having to pay taxes because you contributed in before they took the taxes out. And then the Roth contributions are made with after-tax dollars. So you pay the taxes up front before you contributed to that Roth IRA. That's why you're able to withdraw those tax-free. I hope that made sense to you all. It can be complex, but I'm trying to make it as simple as possible. Just think about it like this. Traditional IRA is pre-tax. Roth IRA is after-tax. So just keep that in mind. We'll just say Roth after-tax, traditional before taxes. Okay, and with the Roth 401k, if the account has been open for at least 5 years and you are 59 and a half or older, your withdrawals are tax-free. And it's similar to the Roth IRA contributions. The non-qualified withdrawals, they may be subject to additional taxes, but only on your earnings. Remember, the Roth, you're only going to be taxed on your earnings, not your initial contribution, because you already have paid taxes on that money. Okay? And the last one, the last two that we're going to be talking about, you all, is the SEP IRA and the Simple IRA. The SEP is for self-employed individuals. It's called the Simplified Employee Pension. And your withdrawals from that SEP is taxed as ordinary income. So it's kind of similar to a traditional IRA. And any early withdrawals before 59 and a half, they are subject to that 10% penalty with some exceptions. Most of the time, you all, there are always going to be some exceptions. You just have to see if you qualify for those exceptions. Okay, and the Simple IRA, that's a savings incentive match plan for employees. So just like they had that 401k for the traditional IRA, the self-employed IRA, they also have incentives matchings that will also, help out the employees. Okay, and then the last thing I want to talk to you all about is the required minimum distributions. What that is when you have money sitting in your retirement account, at some point you are required to make distributions. And the age starting in 2023 was at 73. So if you have reached age 73 and you have not taken any distributions, then you can be penalized for that. So the mandatory withdrawals are included in your taxable income, and they are taxed at your ordinary income rate. So guys, I hope this kind of gave you a better understanding of retirement withdrawals and how you are taxed on them. Again, I am Keisha West. I am an enrolled agent here to help taxpayers, business owners to better understand taxes and how it affects them. If you all have any questions, send them to Keisha, what if, that's KISHA, what if at gmail.com. And on Wednesdays, I will be going live to answer you all questions. Thank you so much for joining me today, and I will see you all again on Monday. Bye. Don't forget, also, you all, follow me here for more tax tips and talks with Keisha. See you all later.